Good morning and welcome to this special MEI briefing. My name is Karen Young. I'm a senior research scholar at Columbia University's Center on Global Energy Policy and also the chair of the advisory council for the program on economics and energy at the Middle East Institute. And I'm so pleased that we have two great experts and analysts to speak to us today, really to try to unpack as we do on kind of a daily basis now, what are we seeing in terms of risk scenario in energy markets within the conflict in Israel and Gaza, broadening now to Lebanon and expecting additional retaliations with Iran or between Israel and Iran. The news this morning, for those of you who may not have checked your Twitter, is that there is the possibility that Israel has killed Sinwar. And so this, we might speak, how might that change any kind of risk scenarios or expectations for next moves. So let me introduce our speakers. We're going to have just sort of a back and forth, and we really welcome comments, questions, interventions. You can do that through the raise hand function, through the chat. We'll have some back-end helpers to make sure that we hear and see your questions. So first, it's my great pleasure to introduce Helima Croft. Helima is in the MEI office, which is a big treat. But in her full-time role, she is the managing director and global head of commodity strategy at RBC Capital Markets. She also sits on the advisory council of the program of economics and energy at MEI, and we are just always grateful for her time and her expertise. And then we also have Colby Connelly. Colby is the new director of the program on economics and energy. He's doing a fantastic job, and in his full-time role, he is a senior analyst at Energy Intelligence. So we all do double duty, and following the region right now takes, I think, a 24/7 kind of approach. It is just full-time. So I want to start with you, Helima, if that's okay. You did a fantastic podcast earlier this week, which I loved, with the Center on Global Energy Policy. And you said something really interesting, which I think we all understand, which is that oil price no longer is a sufficient barometer for risk in the region. It really just, it is either not tracking or essentially the market has decided we will deal with it when there is an absolute hit or attack or some sort of cut to either energy infrastructure or to supply and transit. And that hasn't happened despite the loss of life. So, I mean, I'd love to just hear you kind of talk to us, how this has happened and why it's different than in the past.
Karen, it's so great to be here. You are such an incredible scholar, so it's such a joy to join you today, and Colby as well. But yeah, we think of oil prices as a broken barometer. I mean, if we wind the clock back, just 15 years, when you'd have unrest in the Middle East, you would see oil prices run up significantly. Remember when people would hypothesize about a possible Israeli strike on Iran, you'd see oil prices move. And I think what's happened is that you do have a situation now with, abundant supply in the market. And so people are not thinking about an imminent, supply crunch. I mean, you think about periods where we had higher prices before accompanied by risk, it was often, thin spare capacity margins. And so there was a view that we would be in a situation where we would just not have the supply buffers. That's not the case right now. But I also think that people are looking through this war and essentially saying there has not been a disruption. A lot of market participants got burned on betting on a supply disruption in the Russia-Ukraine war. And remember, we talked about a potential 3 million barrel a day disruption, and that didn't materialize. It didn't materialize because of, release from the SPR, the way we went about sanctions policy to essentially exempt energy transactions. We did the price caps to keep Russian oil on the market. So when we got to this war, market participants were saying, unless there's a direct path to Iran that leads to either Iran doing what they did in 2019, which they hit critical energy infrastructure like Abqaiq, or we get some type of attack on Iranian oil facilities, we're going to fade this story. Basically, call us when there is a disruption. And I think, look what's happened this week with the sell-off. Like, as soon as you got reports in the Washington Post that essentially Israel had agreed to Washington's terms, not to hit energy infrastructure or nuclear sites, the market sold off, even though we are still bracing for an Israeli strike. Even though we don't know what Iran will do in response, the market is essentially saying, I'd like to go back to focusing on soft Chinese demand, oversupply next year, and basically call me when there's something I really need to worry about in terms of a supply disruption out of the region.
That's definitely what we're seeing, but I wonder if you could give us sort of a trader's point of view.
Yeah.
I mean, how does that affect like futures trading? I mean, if you're kind of sanguine about risk right now, then there's going to be a lot of discrepancy in how people are looking forward, particularly towards, I mean, I'm quite bullish on the chance of an increasingly likely a war between Iran and Israel that will draw in the United States. But some people don't agree with that. So what does that do to pricing and forward markets?
Well, I think what happens is that people just aren't prepared for the return of geopolitical risk. Like, look at the run up that we saw before that Washington Post story. I mean, the market was definitely becoming very bearishly positioned, and then was essentially caught off guard by what happened with the Iranian strikes on Israel, and then the Biden response. I mean, what really caught market participants by surprise was when President Biden signaled that energy infrastructure might indeed be targeted by Israel. And all of a sudden, market participants were sort of scrambling to try to assess what the risk could possibly be. And so, Karen, the scenario you laid out, a potentially like direct Israel-Iran confrontation, I would say that that's not in the price right now. I think we've almost seen the geopolitical risk premium come out of the market. And so if that type of scenario were to play out, I think people would be caught very much, off guard by that. And if we were to get something similar to 2019, I keep saying, look, no one's has to have a scenario where the Straits of Hormuz is actually physically closed. But we certainly saw a situation in 2019 where tankers off the coast of Fujairah were hit with mines. We did see critical infrastructure like the East-West pipeline targeted with drones. We saw Abqaiq, being hit in a spectacular attack that took off temporarily half of Saudi's production. But the market has really faded the risk of that happening. I was just on CNBC earlier this week, and the person sitting across from me was essentially saying, Iran is a spent force. They can't do anything. We're not going to see any problems in the market. Like, let's go back to talking about oversupply. And I thought that person was really channeling the kind of market mentality right now.
Yeah, and I think this is really where the regional expertise helps, or it makes us a little bit more paranoid, because we do see this kind of variance in analyst expectations and people who are a little more close to the region. Even this example of the president's comments, how that moved markets, which was very interesting, took for granted in many ways that there was this clear line of understanding between the United States and Israel.
Right.
And many analysts also would challenge that.
100%. Are we really in control of events? But again, I think it speaks to a market that basically wants, a lot of market participants are uncomfortable trying to price in potential disruption risks. And it's easier, I think, to count the barrels. It's easier to deal with the basic supply and demand dynamics. This is not something market participants are comfortable with. And because of that, they just want to not deal with it until it actually becomes a problem. And they also feel like, is it a little bit of the boy who cries wolf? I mean, you keep warning about potential disruption, you warn throughout the year, and it doesn't materialize. And so they're basically like, look, call me when it does, but I cannot get my head wrapped around this right now.
Yeah. So, I mean, then let's think about this from a producer scenario, right? And how kind of, particularly in the Gulf, how Saudi Arabia is thinking about production, thinking about its own kind of risk scenarios. And then I'd also like to ask you how you see consumers and from a government perspective, particularly the Chinese, what we see from Asian consumers, how are they protecting themselves or creating some sort of plan for, within allies, some sort of extra supply lines, or, how are people sort of gaming this out, both on the producer side and on the vulnerable consumer side?
Well, I think on the producer side, this is such an interesting question because obviously if there was a disruption or if there was a run up in prices clearly the Biden administration would do what previous administrations have done, in the US-Saudi relationship, almost in perpetuity. They'd pick up the phone and be like, can you please give us more barrels? And the interesting question would be, like, what would the response mechanism be by countries that hold spare capacity? And I do think we have a little bit of a legacy of 2018 that we would be confronting. Remember when we exited JCPOA, the Iranian nuclear agreement? We asked the Saudis and OPEC to increase by 1 million barrels, saying we're going to take Iran to zero. And they did over that summer, that June OPEC meeting. And then we issued 7 exemptions for importers of Iranian oil in October, and prices crashed to 30. And so I do think that a lot of these countries might be a little cautious about wanting to jump in front of the situation and put barrels on the market to cool a rally when they're not sure what the duration of it would be. I don't think they want to oversupply the market until they really see that there's clear and compelling evidence of an enduring disruption. Also, I think they just don't want to get involved in the middle of this conflict anyway. I don't think they want to be doing anything that makes it look like they're taking sides. And Karen, remember, we were at an MEI event in March 2023, like days before they announced the normalization between Saudi Arabia and Iran. And I think that continues to yield security dividends for the kingdom. It's not, as you know, you will expound on this much better than I can, but like, it's not like they have become close friends. But what that deal has done, I think, has de-risked to a certain extent attacks on their infrastructure. I mean, the Houthis have the capacity to strike a facility like Jizan. They could be targeting directly Aramco tankers in the Red Sea, and they're not. And so the question in an escalation scenario is, would agreements like the one that was struck in 2023, would that ensure that we would not get a repeat of 2019? But the Iranians have already warned that any country that assists Israel in a strike will be targeted. And so I think those are the really important dynamics to be paying attention to.
I totally agree with you. And I also agree that this sense of détente between Iran and Saudi Arabia, and the flurry of diplomatic activity of, the new president, of the foreign minister making visits within the Gulf into Egypt just a day ago, I think can be overread as a sense of security and a sense of calm. And so the geopolitics, as you say, are not priced in, but are also incredibly fragile. So we're going to be watching that. I do want to ask you, and then I'm going to get to Colby more on sort of the gas questions. How you see the vulnerability of importing countries. So how, what's China from this relationship that they helped broker between Iran and Saudi Arabia? What is their next move, or what can they do to protect themselves?
I mean, Karen, that is such a great question, and bringing up the China role in that March deal is important because we have the reporting out that China is now playing, once again, trying to get involved in the diplomatic effort to de-risk the situation. And when you talk to officials from the region, they say, like, look, we want China more actively involved in this dialogue because this directly impacts China, because China is the main market for this crude. But the question is really, like, what is the ability for China to really engineer an outcome that protects its, line of crude in the event that this thing, goes parabolic? Like, we don't know if China, do they have the ability to limit the target list for Israel? Can they really constrain the Revolutionary Guard if, you have really, really serious strikes on Iran? I just don't think we know really the ability of China to essentially provide an off-ramp at this point.
Yeah, and just as a technical question also, I mean, are there differences in the way that China has access to crude versus refined products? We've seen a lot of new refinery activity in China, a lot of storage happening in China. Is that one mechanism of kind of self-protection?
I mean, they do have, you just mentioned the storage. They have strategic reserves. I mean, one thing I think we'd be in a very different price environment right now if we didn't have this soft Chinese demand. I mean, again, like, think about the differences now versus previous periods when we've had major run-ups in prices, like Arab Spring, what in the, around 2007, right before the crash, we had a big run-up in prices. I mean, that was a period where China was really firing on all cylinders. And I do think that the softness in Chinese demand products demand, diesel demand, the sluggishness of the Chinese economy. That's also part of the reason why we haven't had this breakout in prices that you might expect in a situation like this. Again, if we were to get serious disruption, and again, we have to think about what are the serious disruption scenarios. Are we talking about, Iran potentially making it difficult to move crude through the Straits of Hormuz? Like, depending on what is actually taken offline, what shipping lanes are imperiled, that's going to tell us a lot about what China will have to do to make this work.
Thank you, Helima. I want to go to Colby now, and maybe he can get a little bit more specific. We need a nice map out. I mean, Colby, what are you seeing in terms of risk of specific installations, and not just oil, but also gas and LNG mobility within the region? And kind of talks through some scenarios for us, perhaps, as well.
Yeah, certainly. Thanks, Karen. So, I mean, I think the initial fear, which it seemed like had some cold water thrown on it, was that in retaliation for Iranian missile strikes, Israel might hit something like the Iranian export terminal at Kharg Island, which is where 90% of its crude is exported from. So that would certainly take an enormous portion of Iranian supply off the market, and then we kind of got to this point where it was suggested that refineries would be a target instead, and that would potentially be something to be hit in order to disrupt the domestic situation in Iran, maybe resulting in fuel shortages, seemingly geared towards domestic instability. And I think there was also this kind of hypothesis that if Iranian refineries were hit as opposed to export terminals, that it would be less likely to retaliate against energy infrastructure elsewhere in the region, whether that's in the Gulf or somewhere else. I don't think I really buy that. I mean, I think there's just a real danger that once you set the precedent of targeting these types of assets, that thing might sort of continue. I mean, fortunately, we're still at a stage where no one has really kind of crossed the proverbial Rubicon in that sense. But were that to happen, and were Gulf, some of the facilities in the Arab Gulf states to become more vulnerable, I think you would first want to look at things like some of the export terminals in Saudi Arabia and the UAE as some of the major points of vulnerability. I think that's really a worst case scenario. But places like Ras Tanura or Jumeirah in Saudi Arabia, some of the offshore terminals that the UAE has, like Zirku or Das Island, all of those together, are in upwards of seven or so million barrels a day in crude exports, and that's not really a full list. I think certainly, some of these assets are definitely more at risk than others. Certainly, Basra is probably at the lower end of the risk spectrum to an extent. Certainly because you've got a lot of the Iran-linked militia in Iraq that receive revenue, however indirectly through those exports. So I think that's just sort of a case of cui bono in that sense. Other installations could, I think, certainly be at risk as well. But again, these are kind of really the worst case scenarios. I think with a lot of the movement we've seen in the last 48 hours or so, the bigger risk would be something like what Helima was kind of alluding to, that we saw in 2019 with disruptions to maritime shipping, tanker seizures, acts of sabotage, something like that. I mean, that depends, I think, also what the escalatory appetite is at that stage. Which is a separate question entirely, and that is not the same type of situation that you would see if export terminals were to be targeted, because it's not the same type of supply disruption as if you lost export capacity. In terms of gas, I think again, that's definitely another worst case scenario, and I think this boils down to how bad an escalation could get if there were a spillover into the Gulf. I would certainly look at something like Das Island in the UAE as being a bit more at risk. That's the ADNOC LNG plant. I mean, this is more of a geopolitical pointer, but my read of the situation is that if Iran were to disrupt the flow of LNG out of the Gulf. LNG flows from Qatar would be about their least likely target. Given the political importance and relationship that they've had with Qatar, and given where a lot of that supply goes as well. So, these are, I really think, again, and I'm repeating myself a bit, but kind of the worst case scenarios. I think, if you want to talk more about a more direct confrontation between Israel and Iran, which is a lot of what we're seeing, then, the Eastern Mediterranean is in another category entirely. I think the offshore gas infrastructure that Israel has is certainly a lot more exposed to these kinds of risks, whether they come directly from Iran or other regional actors that might have the capabilities to target them. That is, I think, less of an outcome that has a broader market impact. That production isn't very highly integrated with global LNG markets. I mean, the kind of the closest it would come, I think, is the degree to which Israeli gas exports via pipeline to Egypt enable Egyptian LNG exports. But of course, those haven't happened since April because Egypt is in such a poor position relative in terms of supply. Where you would see much more of an impact is much more locally, and what it would do to kind of the energy security picture for a lot of people in the region, really. And I'm mostly thinking about Egypt and Jordan here, Israel to an extent as well, because they obviously use a lot of their own gas, but also have the ability to potentially rely a bit more on coal imports if they absolutely had to, assuming there were no issues with procurement there. So I mean, I can get into some more specifics in that regard, but I think that is kind of the map, as you put it earlier, of where a lot of these risks would be.
Thanks, Colby. I totally agree, and I also think the vulnerability of Egypt has been really underpriced, and what that would mean for the rest of the region, and what that would mean to the Gulf states, to see Egypt really go deeper into a crisis of its own energy security and ability to provide to citizens. I do want to ask a couple of questions that are OPEC related. I see two questions that are in our chat. And I'm not sure if our participants, if you're able to use your audio, you're welcome to pose the questions yourself. Also, Grant Smith, you want to give it a try, Grant? Are you able to? No, doesn't work. Okay. Well, I'll read them for you then. The first one is going back to sort of the politics of the day and this. The implications, if it's true, and it's not confirmed, that Yahya Sinwar was killed last night in Gaza. So are there market implications to that for energy? There certainly are political implications, and you're welcome to take that question either way. Helima, do you want to start?
And Karen, I would love your thoughts on this as well, because I learned so much from you on this. I think the market is always looking for signs that potential off-ramp. And so the question is, will the death of Sinwar, further a narrative that we're unwinding this conflict? I think there's a corner of the market that would continue to always seize on something to indicate that they can sort of turn the page on this. Throughout this year, how many times have we had sell-offs based on reports of a ceasefire, even though there was really not a lot of evidence to indicate that a ceasefire would be successful? So the question is, will it be read as a path to off-ramp or potential, is this going to make the situation more escalatory? So I think it's going to really depend on what happens in the next sort of 24, 48 hours. And again, the question is, with this, escalation, this tactical escalation that we've seen from Israel in the last couple of weeks, does this mean that we're going to have potentially a more, serious strike on Iran than we might have thought about a couple of weeks ago? There's just so much uncertainty at the moment. But I would say there really is a corner of the market that is just very, very poised to pull on threads that this is going to be a crisis that's going to be in the rearview mirror.
Interesting. Colby, how do you feel?
Yeah, I agree with a lot of what Helima said. I mean, it really depends on where this places escalation. this is a conflict that's been going on for more than a year, and in a lot of what I've gotten involved in, I've really tried to avoid being sensationalist about what the actual risks to the energy infrastructure and to the market impact could be. You know, as a lot of what Helima was saying very early on summed up, you know, we don't really live in a world where this arithmetic of Middle East plus war equals high oil prices is applicable anymore. You know, if we're at that point, then you know, let's see. But the point I'm trying to make here is really just that you know, in trying to avoid, you know, reading into how elevated the risks may be, you know, it's only really been in the last couple of weeks or so that it's made sense to you know, be thinking about this in a much more serious capacity without trying to you know, fan the flames of sensationalism. I think we need to be as alert about this as we have needed to be at any point during this conflict. It doesn't mean that that it is the kind of doomsday scenario that I was talking about earlier with respect to some of that other infrastructure and how bad it might get. But you know, we're not on a trajectory at this point, I think, where we can start to relax and say, you know, well, you know, the risks of the price impact or the energy security impact just aren't there anymore.
Yeah, I agree with you both. I mean, my own 2 cents is that if this is true, it certainly changes the dynamics of any sort of hostage negotiations. And so that is, I think, politically the first reaction that we will see, unfortunately. And then secondary effects are that this certainly changes the ability of the interlocutors, of the negotiators, especially those in Qatar. You know, we've seen now you know, numbers of political figures being killed, and that of course obviously erodes trust, right? And so the kind of go-betweens and just, you know, lines of communication are going to immediately break down, and so then that certainly reduces chances for ceasefire, and that's true in Lebanon, and that will be true in Gaza as well. Let's go to OPEC. Grant had another question, and we got a couple others coming in. So please, our participants, you're most welcome to add in the Q&A. Grant asked, and I also had this question, is the oil price supply environment in our current environment, how likely is it that OPEC Plus will proceed with plans to you know, roll back some of the cuts in December, and particularly the kind of Saudi thinking on this? Helima, I know you have a read, so what do you expect?
I mean, I always say this is my read at the moment, and then you get like days before the meeting, and then all of a sudden you're like, wait a second, we're hearing something new. So this is my view at this moment in time. It could change as we are, you know, getting into the last week of November before that important OPEC meeting. But I still think the Saudis are in the mode of signaling that, you know, they're happy to stick with the slow phase in of barrels announced in June, other than the voluntary, you know, sunsetting of those voluntary barrels. But I do think they have been pretty serious in messaging that if you don't get better compliance out of Iraq and Kazakhstan, that they are prepared to make their own decisions about how that 1,000,000 barrels will be brought back. It'll be in the time and manner of their choosing if we do not get better compliance from Iraq and Kazakhstan. And what I also think is interesting is sort of a pushing back on the notion that they can't deal with a period of softer oil prices for a while. You know, all the fiscal break-evens talk about like they need 100 plus to, you know, not be in the red with all their Vision 2030 projects. And you're hearing a more concerted message out of Saudi Arabia, like, well, we can cut spending. We are spending with a calculator. We can delay projects, just like we delayed the, you know, we basically canceled adding 1,000,000 extra barrels of spare capacity to save tens of billions of dollars. We can make adjustments. We can borrow. I don't think they like the notion that they are wedded to 100 plus and everything fails if they don't have that, because that also creates a free rider problem within OPEC. If everybody believes that Saudi Arabia has to indefinitely carry the rest of the countries, like that's a bad dynamic for them. So I do think we have to think seriously about a scenario come December 1, if we don't get those better numbers from Kazakhstan and Iraq, where they basically say, okay, we're going to decide how we bring those barrels back. And that June agreement of slow unwind it doesn't hold. But, you know, the other side of that is, does Saudi want a prolonged stay in the 50s? I don't think so. So it's going to be a very, very interesting meeting. But, you know, I do think they are serious in this effort to try to get better numbers out of Iraq and Kazakhstan. And if we don't get them, we do have to take on board a scenario of like a swifter sunsetting of the Saudi 1 million, which obviously would put downward pressure on prices.
Yeah, and Colby, I'd love to hear your reaction, but also kind of spinning it into sort of a worst case scenario in which we have seen disruptions to supply. How does OPEC and OPEC plus cohesion then, like what would their planning be? Who gets to react, or who gets the opportunity?
I mean, I think, you know, the issue is that if they are going to start tapering at the end of the year, they're not going to do it on the back of a geopolitical premium, in certainly in prices. You know, they want more certainty on whatever kind of decision they're going to make. They in fact like to historically say it, certainly at least during the Russia-Ukraine conflict, that we're not going to add barrels because of a geopolitical effect. Actual supply disruption. In of actual disruption, though, whether or not we get to the point, I think that's part of what does make this issue of risks to assets in the Gulf fairly dangerous, is the fact that, you know, if Iranian supply, say, goes away, and you know, the question to be how long does it go away for, of course, but let's say it goes away for an indefinite period. You know, how much worse does that make the security environment in the Gulf? Because while OPEC has plenty of spare capacity that they can cover that supply loss with, most of it is in the Gulf, right? So if that security environment just deteriorates to such an extent where there's attacks on infrastructure, or shipping becomes a mess, then we have a serious problem, because that capacity that was supposed to replace that other supply is just that much harder for us to get to. And I think that's what a bit of the understated risk to this situation is. And again, it's still a worst case scenario, but I don't think we've been closer to a worst case scenario than we've gotten in the last couple of weeks. And I don't want to blow that out of proportion. But this is the time to think about those things. So I think that would be the riskier situation OPEC would find itself in. Again, I mean, it's not a guarantee that supply disruptions last forever. Cake didn't last that long, and Aramco was able to pull barrels out of storage from different parts of the world and make up for it. So there are contingencies in place for something like that, but that's not a reason to waive the risk factor away. I wouldn't want to just say, you know, we'll get by on what's in storage or something like that. So.
Well put. Thank you, Colby. I want to go to another question from our participants. Kate Winston asked about the recent U.S. strikes on Houthi targets, and I think she's referring to the targets that were deep underground. And so there's been a little bit of an air show happening in terms of U.S. defensive capabilities, what kind of aircraft and the types of munitions that are moving into the region, both offensive and defensive. So I think that's what she's getting at. Does this have any impact on energy markets, just this kind of show of U.S. force?
I mean, again, I think we're in an energy market that is largely looking past this. And I think this is an important story, by the way. And again, I'm just so struck by the conversation we're having today and the risks we're laying out. Whereas again, if you just look at that CNBC interview I did earlier this week, the guy was like, nothing, there's no risk in this market. Who cares? Move on. But to me, you know, it is a really interesting question is, was this a warning to Iran? Like, we have the capability to hit things deep underground. So we have bunker busting bombs that we could take out Fordo. Like, if need be, we could inflict significant damage on your critical infrastructure. Was that, I mean, it was Iran the intended target of that message. And the question is, does that in any way change the Iranian response mechanism to the Israeli strike? I mean, we do know from conversations in Washington that the Biden administration is hoping that the Iranians essentially stand down after what's coming from Israel, that they want essentially a repeat of April, where you had the Israeli strikes on Isfahan, and then the Iranians were like, okay, we're good, we're done for now. So the question is, was this part of an effort to ensure that Iran, the day after an Israeli strike, says, okay, we're good, let's park this latest round of escalation and move on to something else?
Colby, any thoughts on these recent strikes, U.S. strikes in Yemen?
Yeah, I mean, I think if nothing else, one of the things it highlights is just that the alMandeb is going to continue to be a long-term problem. That's not going to go away anytime soon. I think a lot of consensus has shifted more towards the view that, even if there were a ceasefire in Gaza and this current conflict ended tomorrow, this is still a point of leverage that the Houthis are going to want to use at some point or another. I mean, I'm not going to speculate on what the reasoning might be, but it's going to be something that has to get considered. In this market, it's been largely priced in, and it hasn't had an enormous impact. But I think it's going to affect certain aspects of long-term decision making for some time. If you look at where some of the Gulf NOCs have put money into LNG assets outside their own countries, they've done it in places that can largely avoid the Bab el-Mandeb to get to either Europe or Asia. And I'm not suggesting that that's the primary decision-making factor there, but I hardly think that it's outside the scope of things that are being considered for these types of investments. So it's something that the market has to consider. I mean, choke points that get talked about from a theoretical sense all the time, but I think certainly in the type of world we're living in now, they're a little bit more at the forefront than they used to be.
I think that's really smart, Colby, and it kind of gets us into the geopolitics and looking forward for challenges to the next U.S. Administration. We talk a lot in MEI about what U.S. foreign policy towards the Middle East will be, either under a Harris or Trump administration, but it will be a challenge for either. And all of the momentum on the pivot to Asia now is pretty much consensus that there needs to be a concerted presence and attention paid to the Middle East. And the Houthi issue, exactly as you describe, is one reason why. And they're not going away, and they're just emboldened, and they do feel that they have sort of gained their moment, even though the rest of the region would really like to kind of pretend that it's okay and put a lid on it. So that leads me to one of the questions we have from our participants. Bashar al-Halabi asked, how would a Trump presidency impact OPEC plus policy? But I think a broader way of thinking about that is, if we do see Trump in the White House again, how would this affect the U.S. position towards the region at large and energy supply, particularly the relationship between key producers and OPEC and OPEC plus?
Yeah, I'll start on that one. I do think there is a view in the market that a Trump presidency, where it could be more supportive of oil prices, is a potential expectation that he would more strictly enforce the existing sanctions architecture on Iran, particularly the secondary sanctions, and try to pull off a significant amount of Iranian oil exports. The question I have about that, though, is, because I've talked to some people pretty close on the campaign, is would you look to do that in the absence of a backfill from the Gulf? Because again, remember in 2018, we exited JCPOA, but got 1 million extra barrels from Saudi Arabia and OPEC to fill a gap that didn't really materialize until a year later when we imposed maximum pressure policies. So the question is, would President Trump look to tighten the sanction screws if he did not get guarantees of additional supply to backfill Iran from Gulf countries? And given what's transpired, would Gulf countries want to be seen as essentially getting in the middle of this, again? So I'm not sure that we're necessarily going to have on day one President Trump being like, okay, we're going to zero on Iran. There's just, can you actually get to zero? But you could obviously take more off the market than we're seeing now. I'm just not sure he's going to pull the trigger on that. And then the question is, again, what's his relationship going to be like with a number of the key Gulf producers? Would you see an effort to revive this, U.S. Saudi, grand bargain under a Trump administration? Could he get it done? One of the key, factors, it seemed, was the fact that if you had a Democrat in the White House, it would be easier to get congressional approval of that deal. Would he be able to get congressional approval, with, even if the Republicans take the Senate? Like, is it going to be easy for President Trump to get that deal through? So that's the kind of things I would be watching for.
Yeah, thanks for bringing up multifaceted U.S.-Saudi agreement that's been kind of put on ice. That's a really important consideration. Colby, what's your outlook for the potential of a Trump presidency and posture towards energy markets, OPEC, and kind of a U.S. presence?
Yeah, I mean, I don't really have anything. I think I can say better than what Helima did. I think we've kind of gone through this cyclical uh, policy outlook of where for a number of years now a new president gets into the White House and wants to figure out how to basically stop paying attention to the Middle East. My analogy for this is always kind of corny, I guess, but I'm really hoping whoever's president ends up being president next learns that the Middle East is essentially Godfather 3. Just when I thought I was out, they pull me back in, right? And trying to pivot too sharply away from it is just going to cause all of these issues to come back to the fore again. Like you saw with Biden in 2022 and trying to squeeze more output from OPEC, whoever it ends up being. The less you pay attention to it, the harsher the consequences, I think, of these things are when you have to turn back to the region for more supply or anything along those lines. So hopefully there'll be a little bit more foresight in that regard, whoever we end up with in November.
Okay, Colby, thank you. If there are any other questions, you're all welcome to put them into the Q&A. We'd love to hear from you. Colby, I know you're following more on the gas markets a little bit more closely. I mean, if you can, you talked a bit about East Med risk and potential targeting of what we might see in Tamar or Leviathan if things continue to heat up on the Israel-Lebanon front. But, can you kind of talk what that means in terms of global supply, Europe's energy security, and we talked about Egypt being particularly vulnerable, but who are the other vulnerable cases? I believe, Israel's or the basically East Med capacity, what is it? It's less than 5% of global LNG, right? So it's not a huge part of the market, but who is most vulnerable to disruption there?
Well, the vulnerability, I think, really comes from how much, if Egypt lost Israeli supply, how much of a greater draw would they be on LNG markets? Because that's really their only other way to make up for that kind of a shortfall. And the risk has pushed some of the benchmark prices up on the Dutch TTF and Northeast Asian prices, but it hasn't been an extraordinary effect. I think it's just a little bit of wariness about the potential for Egypt to kind of go on the hunt potentially for more LNG cargoes. They have one FSRU, which enables them to procure those imports. But in order to make up for the type of shortfall they would have if they, let's say tomorrow lost all of their access to imports from Leviathan and Tamar, they don't have enough of FSRU capacity to make up for that shortfall. So it's really a situation where Egypt just runs into that much more of a supply crisis, and I mean that's an upwards of 100 million people, right? It can't be really understated. So it's like you said in the beginning. I think that risk has really kind of been a neglected component of what's taking place here. It's the lights going out, but it's also heavy industries in Egypt grinding to a halt. That took place a couple times during the conflict when production from a couple of different Israeli fields was stopped for very short periods of time. And it did give us a preview of what that could look like. Egyptian imports of Israeli gas are at record levels. I would guesstimate that it's probably around 20% of their daily consumption at this stage. And then, of course, Egypt's economy has not been in great shape. So if they have to turn to the LNG spot market in order to make up for that shortfall, it's just going to cost them dearly. And just because they'll be able to make up for some of the supply, it doesn't mean they'll be okay. It's going to be a much worse situation.
Yeah, I agree. I want to take the aperture a bit wider now and ask you both. what does this do in terms of the investment picture for both oil and gas on sort of a global scale? We had some big reports coming out yesterday and sort of our energy outlook, and certainly there's an improvement and increase in investments within the renewable energy space. But do you see this conflict, or a general, certainly within oil markets, a sense of comfort and oversupply as having an impact on new projects? Helima, you mentioned some Saudi projects that are being canceled, but is there a bigger or macro trend to that across oil and gas? And does it have any relation to some of the issues we're seeing within the region? And it's a bit of a leading and perhaps hypothetical question, but curious.
I would love your thoughts on this one too, Karen. I mean, I do think I go back to the decision of the Saudis to not increase, the maximum spare capacity by 1 million barrels. And, initially it was read by some in the market as the Saudis essentially sort of throwing in the towel, saying, you know what, the demand's not going to be there. Why make this investment? I thought it was very interesting, some of the commentary that you would hear from Saudi officials, where they would also just say, like, look, we have to be careful about what we spend at the moment. And we are very focused on our diversification goals. And we want to deploy that capital, the tens of billions that we're saving from making that investment, to better projects. And some of those went for, Saudi Green Initiative projects, gas projects. But they were basically saying, like, we have to reprioritize. And this is probably not the best use of capital. But there was also an interesting geopolitical component to it as well, where they were also saying, like, look, it cost us to be the central banker of oil. It costs us money to basically be the ones holding spare capacity whenever there's a crisis for the world. And you know what? We're not sure that that's the best use of our money right now, is to essentially be the reserve holder of additional barrels. So if there's a problem come, years from now, you may not be able to call us. We might not be there in the way we've been there for you in the past. And, one official said to me, like, look, you yell at us when you say we're producing too much because of the effects on emission. And then you yell at us when you say we're not producing enough because of the effects on prices for consumers. So, you know what, like, yell at somebody else going forward. So I do think there was some really interesting dynamics around that decision that we haven't fully explored.
Yeah, I agree. I do see this confluence of the kind of the energy transition, the political lack of trust, and just basically efficiency and cost saving, and fiscal responsibility kind of playing into what will be the future of the market. Colby, are you seeing any big trend lines there?
I mean, yeah, I think everyone certainly that's in the Gulf and that is a participant in OPEC is looking at this in an interesting sort of way. I mean, it's a less significant development than the cancellation of the Aramco expansion, but you did see ADNOC recently decide to cancel its expansion at Das Island. So I think you will see kind of a review of what's in the pipeline and where those rationalizations need to be made. But that being said, we're also looking at a very, very strong outlook for non-OPEC supply next year, which has got to be a concern for OPEC, because by some numbers that growth has the potential to cover demand growth next year. Again, like I said, by some numbers, but there certainly seems to be, and I think especially among some of those newer producers, like for instance Guyana and down the road a bit Namibia, an impetus to just get those barrels out and get them on the market, because we don't know how long the party is going to last, so to speak, and you really don't want to delay. So that's I think something that everyone in the Gulf who's looking at what OPEC should do is going to have to take into consideration. I'm sure they are now, but certainly more so as the years continue to go by.
That's right. And if we have a Trump or Harris administration, I think neither would be in opposition to increasing U.S. production, right? So we've seen a bit of a switch in our own domestic politics there. Well, this has been a wide-reaching and really fun conversation. I love talking to both of you. I don't see any other questions with our participants, so we can go a little bit early. And Helima, just really grateful for your time and being at the Middle East Institute today. And Colby, thank you for the great job you're doing with the program. Thank you, everyone. Stay safe and have a good rest of week. Bye-bye.
Hi, thank
Thank
you.
you.